All right, so we started the recording. If you guys could just accept that, please, and we'll get going. Welcome. Today's Thursday, February 9th, 6:31 p.m. And I'm really excited. Really excited about this. You know, we're 5-6 weeks into the new year, and this is an awesome workshop that's a foundational piece in everyone who's ever accumulated any type of wealth. This is a foundational piece that they went through, whether they know it or not. They had to first eliminate debt. And then secondly, they had to build their credit, because that's how you get rich, right? By not having debt and by building great credit. That way the banks start loaning you money. So before we get into it, let me just quickly introduce myself. My name is Voltaire Lepe. And Claudia, if you can allow me to share my screen, please.
Yeah.
And also allow the other co-hosts to share their screens if needed. All right, here we go. And this is the How to Eliminate Debt and Build Your Credit workshop. I'm Voltaire Lepe. In case you don't know who I am, this is a little bit about me. Born and raised in San Diego. Been in real estate since 2002. That's 20 years. We're full-time property managers, full-time residential and commercial brokers. And we have over 30 sales associates here at the office, a big Lepe Tendwell family that we have. The coolest part about me, I think, is I have 38 tenants right now paying me rent on a monthly basis. So I live a really awesome life because my tenants pay for all my properties and pay for all my life expenses. I love my tenants. And we manage all my property plus a bunch of our clients' properties. I've been in it for a long time, and we teach workshops like this to adults and financial literacy to kids. So if you ever want to have your kids jump on too and learn some things, then we do that. And then we give back to the community, give back a lot of money and a lot of time. Now, before we get started as well, I just wanted to remind you guys that we have 2 workshops a month. All year long, we have about 24 workshops a year total, different topics. So if you want to receive invitations to our workshops, feel free to send Claudia your information, and then she'll sign you up as part of our newsletter that you receive those invitations. That way you could join. The other thing too is, you know, everyone here, every person on here that's a realtor, that's part of Lepe Tendwell family, the person who invited you, you know, we're all referral based. That's our business. So if you like what you see today, do us a favor, go on Google, on Yelp, find us, and then review us and just say, hey, I went on their workshop, a lot of great information, and give us a 5-star review. We'd appreciate it. Thank you very much. All right. So now today we do have 2 guest speakers that will help us understand exactly how to eliminate debt and how to build your credit, right? So the first speaker we're going to have today, his name is Michael Ayala. And Michael, if you want to unmute yourself, and if you just want to share with everyone a little bit about yourself, who you are.
How's it going, everybody? My name is Mike Ayala. I own 5 Diamond Credit, and been doing this in my team for about 6 years now collectively. We have helped thousands of clients, and primarily, you know, my goal is to reach out to as many realtors and loan officers and obviously educate everybody out there on you know, what they don't really teach you in school, which is you know, coming out, most of the kids at 18 years old that come out and get a credit card and then rack that thing up and then, you know, make some bad decisions and pretty much hurt themselves for the long term. And I guess what most people not being educated on the fact that these things can be removed depending on kind of what their circumstances were, you know, to kind of essentially give everybody a second chance with being able to remove all these negative items on their report and then help them and educate them to be kind of financially responsible. I don't know if you want me to kind of get right into it.
And we'll get right into your presentation. I just wanted everyone to know who you are. Thanks for introducing yourself. And then we have Art Aguirre, lender extraordinaire. Art, if you just want to mute yourself and just briefly tell everyone who you are, a little bit about yourself.
How's it going, everyone? Hope everyone's having a good evening. So just a little bit about myself. I've been in the mortgage industry for 12 years. And, I usually try to just help out the community. I usually work with a lot of first-time home buyers, investors, and pretty much my job is to educate them about the loan options that are available for them, different loan options, obviously educate them, credit history, we're looking at credit history, employment, all that good stuff, and just put a plan together for them to move forward and purchase a home.
Cool. Thank you. I appreciate it. And then last but not least, we have our lovely co-host, Claudia Lomeli. Thanks, Claudia, for being on the controls. If you have any direct questions, you could just, shoot them to her. If at any time you could raise your hand and then we could call on you. So first, the floor is going to go to Michael Ayala. He's going to tell us the first thing, which is what's credit? How does it work? Why should we be concerned? So, Mike, please share with us what you got.
Perfect. Thanks. So credit score, right? Everyone knows the main three bureaus, which is Experian, Equifax, and TransUnion. With someone like Art, first-time home buyers going in, you're going to need to have a certain score depending on obviously what type of loan you're trying to get. So obviously credit score is going to be imperative, not only just to be able to apply for certain things, but obviously to get a better interest rate when applying for those things. And that's going to be the biggest factor of, certainly you could afford more things if you're able to have a lower rate. You can have maybe a higher car or a more expensive vehicle, or get a more expensive home, but then you're also not going to be wasting more money. That could be more money going back into your pocket instead of spending it toward a bank because your credit is not good.
Okay, so with good credit you could save some money, number one, and then number two, you could afford to buy more things because you just get better rates.
Absolutely. And personal side, and obviously I do the business side as well. So certainly if any people in the rooms, are realtors or anyone trying to have a business as well, you can leverage OPM, what's called other people's money, to either expand maybe your business or purchase more rental property to have a passive income stream. I mean, there's that's a whole other topic, but certainly it all comes back down to your personal credit, because in order to get business credit cards or get loans, they're going to have to run your personal credit until you're able to build up that business credit, which over time then they'll be able to not have to have use your personal.
Okay. So Mike, let's go into specific examples. Do you have anything you want to show us or talk to us specifically? That way we kind of start get an idea of how credit really is powerful.
Yeah, absolutely. Essentially, I had a client, for an example, had an auto loan. I repaired their credit. They had a lot of negatives on their report, wiped their credit clean. They went out, refinanced their auto loan that they had. Their initial loan was just over $16,000, and they were paying just under $900 a month on that loan. So they had it was like a 25% interest rate, which is astronomically high for a vehicle loan. After I repaired their credit, they went back, did the refinance. They ended up getting a 6%, it was like a 5 or 6% loan, and dropped their monthly payment to about $319. So they saved about $500 plus dollars every month on that alone, just by I think their scores, they went from like a 5, it was like a 550 up into about a 730. I think it was like a 736 score. And so just by doing that $500, I mean, is obviously Gonna save them tremendously.
And let me do this. This is your notes from earlier, right? So everyone's visual. We want to see it visually. So this is some results of a process, an example, right? So this is exactly what you said. There is a loan on a car your client had for $16,000. Their payment was almost $900, $879. And then they contacted you and they said, hey, help me with my credit. You helped them with their credit, it got better. And after the credit repair, they refinanced the loan and their payment dropped to $319. So that's almost 600 extra bucks a month, 560 total savings just by having great credit. Now, give me an idea of what number their credit was before they started and what number it was after their credit got better.
So yeah, so they were around like a 550 score, and they went up to a 730. It was like a 736.
So 700. What's considered great credit, good credit? Like what numbers?
Yeah, so over 720 and above is considered in the excellent category. And then yeah, I mean between they say 680 and 720 is kind of in that middle category, and then obviously below that you don't really want to be below that, because then most of the loans and you're going to start getting either high interest rates or just start getting denials.
Got it. Okay, so everyone here should strive for what, a 700 and what, 20 you said?
I mean, yeah, the minimum. I try to be at least like a 740 now, because
740.
Like even like Amex, they're getting a lot stricter with their guidelines, and I'm seeing a lot of people like a 740 or above to get for a credit
740. So that should be everyone's goal. So everyone at home, write it down. 740. That should be your goal for your credit. Now, let's look at this example in this car, right? If you're saving $560 a month, and that was a 24-month loan, right?
Mm-hmm.
I mean, that can't be right. Are they really saving $13,000?
He had like 2 years left, on that loan. So yeah, that's what his balance was. But yeah, that's
So he's saving just on interest $13,000 on a car. I think for everyone out there that's watching this, it's like, we're trying to do our best job here to explain to you how powerful having great credit is. And what I did was I took Mike's example of his real life client who, again, has bad credit, right? Had bad credit, had a car loan of $16,000 and some change. He was paying $879 a month. And then from there, after his credit went up to 700 plus, his car payment, after refinance, because he had great credit, now he got a way lower interest rate, and that came out to a $319 monthly payment. So in essence, it saved him $560. If this guy would have never fixed his credit, never would have got a better interest rate, he would have paid an extra just on interest alone, $560 a month times 24 months. That's $13,000 for that same car. So, and he only owed, when he came to Mike, hold on, for some reason I can't.
1,000, like four something, yeah, four.
Yeah, it was a joke. I mean, yeah, 16,000. He owed 16,000 on the car, and he was going to pay 16,000 principal. Okay, he's going to pay them back the 16,000 he owed them, plus 13,000 in interest if it wasn't for his credit being above 700 after he finished with Mike. So he really would have bought two cars.
Yeah.
Right? He would have paid for two cars, but only kept one.
Right.
So that's the power of how great credit works. And you guys can see my calculator, right?
Yeah.
Yeah. All right. So does anyone not understand this process here that we just went over, just so you could kind of like actually understand how powerful credit is? Or any specific questions about that? Because that's amazing. They just saved they just put $560 in their pocket every single month by having good credit. Okay, so now if there's no questions there, and Claudia, you could tell me if there is or not, but now let's look at what makes up a credit score. So
Sure.
Go ahead, Mike.
So yeah, so I mean, there's a couple different things that the score is calculated. Payment history. So that's huge. Making sure you're on time, no matter if you have a card that's maxed out or not. Just make sure you're at least making the minimum monthly payment. I saw a client had great credit after I fixed him. He ended up coming back to me. He had one late payment on his card, and it ended up dropping him 45 points just for the one late payment that he had. And so it's huge. It's super important to just make sure, even if it's the bare minimum monthly payment, just make sure you're at least paying that 2 days before the date of your statement date.
Okay, so 35% of your credit score is made up by if you pay on time.
Correct.
That's a big chunk. 35%. That's yes. Crazy.
Yeah.
Okay. So it's easy. It's easy to have good credit. You just got to pay on time.
You just got to
even if it's the minimum. Even if it's the minimum.
Even if it's the minimum balance, just make sure you pay the monthly payment, and so then it's just you'll never get a late that way. But yeah, even if it's the bare minimum, whatever they tell you owe for the month, just make sure that's paid.
Okay, cool. What's next?
Usage. So your credit limit, say you have $1,000 card, if you have $900 on there, you're using 90% of that credit limit. So that can have another big chunk of your score, where I saw one guy, I think he dropped 80 points when I had him pay off. He had 2 credit cards, and they were small. It doesn't matter the amount. They were both like, one was a $300 card and the other was a $500 card. So very small limits, but because he was maxed out at 100% on both cards, he had paid those off, and yeah, I mean, his scores jumped up like 80 points just for paying those off. So your usage, I tell all my clients, try to be below 20% of your limit. That'll have the least amount of impact on the scores. And anything over that can have, up to a 30% impact on your scores.
Okay, so what you're saying is, just because the credit card companies gives you a max limit of $10,000, it doesn't mean that you should always use up the full 10,000 if you want your FICO score to go up, your credit score.
Correct. Okay. So if you can pay the cards off every month, that's typically, I try to coach all my clients, like, hey, whatever, if you go buy to the grocery store, make sure, or if you're going to go make a big purchase, at least try to make sure you have that money in cash so that you can pay that card off, and then your scores will just stay the same at the highest possible for whatever other trade lines and everything else you have on there, and they won't fluctuate.
So a pro tip that I do whenever I know I'm going to purchase a piece of real estate or get anything on credit where they're going to run my credit score, what I do is, I know my billing cycle. I don't know if I'm using the right term, Mike, but I know when my credit card companies report to the credit agencies.
Yes.
So mine's is like on the 24th. I have 2 credit cards, 24th and like the 26th. So basically, like on the 23rd, 22nd of the month, I go in there and I make sure that those are at 0 balances. So I pay down my credit cards to 0.
Yeah.
And then I call my loan officer, I call Art, and I go, hey, run my credit now.
Right. And
then when he runs it, the credit card companies report 0 balances. Right. And then my FICO score shoots up.
Sure. Yep.
And then all of a sudden, the loan officer or the card company, whoever's going to give me credit, they get the high score. They go, wow, this guy has excellent credit, because it shows that I don't owe anything on my credit card balances, because the usage is 0 at that point, right?
Correct. So like, by all means, if you need to carry a balance, if you're not having your credit ran, by all means, you can carry a balance as long as you want. Obviously, you're just going to be paying the high interest rate that credit cards have, but yes, like 3 days before your statement date, pay off. If you want to have that as a 0 balance for the next reporting cycle, pay that off, and then it'll report as a 0 balance, and then your scores will be as high as they can be for the next thing, the years of history that you have available.
Cool, perfect. And then we have a couple questions. We'll get to them in a bit. Age of history, what's that mean?
So the years that, so if I go open up a credit card, it's going to have, the first month it gets reported, it's going to be a month old of that's your age of that trade line. So you want to have old cards so that, the newer your credit cards are, every time you add a home loan, a credit card, a personal loan, auto loan on your credit report, you're reducing the years of combined aged history. So they say 5 years combined with a zero balance and perfect payment history is how you get an 800 plus credit score. So 5 years, obviously you want to have one card and leave it there. I don't care if you got to go buy a pack of gum once a month just to keep it open and active and put it in a shoebox or something. Don't touch it. Leave it there. You want that card to be, 30, 40 years old. So then the older it is, if you go add a new vehicle or get a new credit card or a loan, the impact it'll have won't be as detrimental as it would if you're just starting out and you got a couple, if you got a 3-year-old card, as soon as you get a new credit card, well, you just chop that combined age history in half. So you're going to drop in points, maybe 20, 30 points, something like that. And then, you'll have to just keep rebuilding that up as you, just nothing but time can rebuild that up, month over month and year over year of positive payment history.
Wow. So if let's say I have a card has a lot of history, 10 years of history, perfect payment history, whatever, but the card, let's say, doesn't give me points on my purchases, and the card it has an annual fee that I don't want to pay, and I have other cards that I like better. What do I do with that card? Do I just rip it up and cancel it? No. Okay.
Leave it open, never close. Perfectly good, as long as if there's no lates on it, it's a perfectly good history. You want to just leave that open. Make sure it's active and leave it open. Don't touch it. You can go certainly get a new one that'll pertain to whatever it is you want to do, more points, travel miles, whatever that might be, and that's totally fine. But you want to have one card that's the oldest possible. Just leave it, don't touch it, don't ever close it. You want that perfect history to stay on your credit report.
All right, well, I've made a couple mistakes in my life with that. All right, what about the new credit? What does that mean?
And then just new credit, basically that's just new trade lines being added on. So when you go get a new vehicle or a home loan, and that's that and mixed credit is kind of in the same category of just, they want to see that you have multiple different types of trade lines open, not just like one credit card on there.
So what do you mean by mixed credit? Give us some examples, please.
So basically having a vehicle loan is one trade line on there. Having a home mortgage loan, that's a separate trade line. Having a credit card, that's a separate one. Having a personal loan, so all those a combination, a mixture of different types of trade lines on your report.
Got it. So the more credit you have, different types, it does help you. It has 10% of
a little bit, yeah.
total FICO score.
Yes.
Okay. All right, cool. So now let's go into some of the questions. Someone asked, well, the first comment is that savings that we went over earlier, that crazy number of like $13,000 or something.
Yeah.
Holly, an agent here, she said $13,000 is almost a down payment for a first-time buyer. So you see how you start saving money, and then all of a sudden it accumulates, and you could use that money for other things such as investing and buying, using it as a down payment. I mean, it's just amazing what you could do with the extra money. So that's good. There's another question. What do you recommend young kids do in order to build credit? Young kids, I don't know how young, but you can take it.
So I mean, like for myself, I was 16 when I first got my first credit card. By 21, I had an 810 credit score when I moved down to Los Angeles. So the one thing you could do is open up a card for a child and don't give them access to it, I would say, or, teach them to be responsible with it. And, hey, if they have an allowance, make sure that whatever they're going to buy is in their means of the allowance that they're getting. The other thing you could do to start up is the best thing without having to give them a card is the adult or parent can add the child as an authorized user. So then they'll automatically get all the years of history on that card right onto that child's credit report. So then they'll have all that on there, and then they don't have to issue a card. They don't have access to use that. They'll just get all that years of history put on their report. So then when they are ready to go get their first credit card, they can essentially get a lot better one than if it would just be kind of like a starter card with a very small balance, because they have an old trade line on there with a lot of years of history.
Wow, that's great. How old do you have to be to get a credit card?
Ooh, that's actually a good question. I mean, if I go into 16, I guess essentially, as an authorized user, I could probably put one on anybody's credit report at any age. But typically, I guess a certain amount of depending on where you're going to, I think 17, 18 range.
So when you were 16, you applied for it on your own. You got it on your own.
Yeah.
Oh, wow. Okay. I didn't know that. All right. That's cool. That's good to know. I got a bunch of nephews and nieces, so I got to run up their credit and buy me something good with it. All right. Does having a black card help with credit scores?
No, and actually, all Amex cards, because they're not credit cards, they're charge cards. So, they basically, charge cards you got to pay them every month, and then they get reported very differently to the bureaus. Sometimes they'll come on. I've seen them where sometimes they'll get reported to the balances. Sometimes the balances don't report because it's a charge card. So those really aren't good for building anybody's credit. From the gold to the platinum to the black card, none of them are because they're a charge card. They don't really help you very much. But as far as like points wise, well, I mean, the gold card is great for purchases, and they get like 4x and 5x for points. But as far as that goes, with that being a card to build credit with, they're not good. They're not good for that. They're more just for show.
Oh, okay, cool. I have a card and I have not used it for over a year. It has zero balance. Should I use it? And that sounds like a yes.
Yes, absolutely. Make sure you keep it open and use it to go, buy a gas station or something, and then just make sure it stays open.
Cool. Should we keep our credit card ratio between 30% or 10%? I've heard both.
And that's usually, I tell all my clients to be at 20% or below. Certainly, again, if you can afford to pay off your balances every month, then your score is not going to fluctuate. It's going to stay at the highest possible with all the other categories that you have. So but yeah, I mean,
so look this is a myth, guys, and everyone needs to listen on this because it's very important. A lot of people think you need a balance on your credit card monthly, and you need to be making interest payments to your credit card holder in order to have good credit. And I hear this all the time. It's a myth. I don't keep any balance on my card. I never pay interest payments, and I have a 800 plus FICO score. Okay, you don't need to pay any money. Do not lose any interest. Okay, by paying or keeping a balance when you have the money in the bank. Do not do that. Let me see. Okay, I think that's all the questions for credit. And real quickly, can you just explain your process? How much it is to hire someone like yourself to help with credit?
Sure. So my process, basically, what I do is go through, I'll have a consultation call, go through with the client, tell them, okay, I'll run through the report, tell them how many items are on their report. Based on how many items I'd be removing, I charge a flat fee price. So 0 to 10 items starts at $1,500, and it goes up $500 every 10 items that I'm removing. So 10 to 20 is $2,000, 20 to 30 is $2,500, and so forth and so forth. And then process time could be anywhere 4 to 14 weeks is kind of the average time frame. Of course, depending on the items. If there's the bigger items like bankruptcies, repossessions, evictions, child support, usually quote those in about 4 to 6 months. Everything else is usually 2 to 3 months time frame. I've totally had clients finish in the first 30 days. So that's certainly possible. But average is right around that 2 to 3 month time.
Okay, so for a few $1,000s within 6 months, you can have awesome credit, and then you can start saving money. And by the way, that's expensive. However, what's even more expensive, this $13,000 number, if I'm still sharing this, if you guys could see this calculator, $13,000 and that dude was going to pay if he didn't fix his credit. And this is all interest payments. That's no principal. That's all interest. So thanks a lot, Mike. And hang around because there's gonna be some more questions. There are some more questions right now, but we got to keep it pushing, and then we'll have some more question time later. All right. So now, welcome, Art. You can unmute yourself, and Art's gonna show us basically how credit would impact your home purchasing. And how debt would impact your home purchasing. That way you guys can really understand how powerful it is to have zero debt and a good credit score. So,
sorry, do you need me to open your slideshow or?
I have it here. I have it open.
Yeah.
I have it open.
Okay.
Okay, thank you. Good catch. All right, so here we go, Art.
Perfect, guys.
This is you with a suit. Okay.
So perfect, guys. So I actually built a couple scenarios. What we're going to go over is obviously how your credit score impacts your interest rate, your monthly savings, your, annual savings, life of the loan savings, and then how your liabilities on your credit report affect you with qualifications, like your purchase power. So if you guys want to slide to the next one, I put like a scenario here, and we're just going to do an example. Somebody purchasing a home of $800,000, and loan amount is going to be $640. And on the left side, on the grade scale, you guys can see the credit score is 755. The interest rate that they can be receiving is 5.875. And on the gray scale, you can see their payment, how it breaks down, right? So their principal and interest is going to be $3,785. In 84 cents, tax is going to be $833, insurance $72. Their total monthly payment on their mortgage is going to be $4,691.17. The total income needed to qualify for this mortgage would be $9,384.22. So that's somebody with great credit score, right? And somebody with like a more of a challenging credit score, somebody with like a, for example, right here, a 630. Look at that rate hike, guys. It jumped from 5.875 to 7.375, right? So here's their breakdown of their mortgage. It's $4,420.30 principal and interest. Taxes and insurance will obviously remain the same, but their total payments now is $5,325.65. Now their income to qualify for this mortgage is $10,653.43. So obviously now you need more income because of that challenging credit score. You got to qualify for more, right? So obviously, the monthly savings between these two interest rates, it's $634.48 on a monthly basis. On an annual basis, you're looking around $7,613.76. Let's say these people never refi, your life of the loan is $228,000 and or $228,412.80. It's a lot of money, guys, to be saving, on the life of the loan. It's $228,000 in your pocket instead of the bank's pocket. So
everyone understands, because I'm excited about this. Art sees this every day, so he's not really excited about this. I am. On the left side, that's great credit, right? So if they're both buying the same home, $800,000 home, guys, on the left side, it shows you that they only have to earn $9,300 a month to qualify to buy this property, and their payment's almost $4,700. But if you're the person on the right side with a 630 FICO score, you get a way higher rate in the 7% range, and you're going to need more money at your job. You're going to need to earn more money at your job, $10,600 compared to $9,300. In order to qualify for the same property, guys. So that's a huge difference, right? Because if you don't earn $10,600 and you're earning the same as this guy over here on the left side, then all of a sudden you're buying a lower home than $800,000, right? But the crazy part is like Art pointed out, if you hold the property for a 30-year mortgage, over the life of the entire mortgage, guys, you're saving almost $250,000 in interest only, right, Art? It's not principal, it's just
Sure.
interest.
Correct, interest only.
That's crazy.
It's crazy. That's a crazy number. That's pretty much another condo, you know?
Yeah. And I like the way you named this, the cost of your credit score. So the cost
Yeah.
of having a bad credit score
Yep.
is $228,000.
Yeah,
Mhm.
and also it also like paints a picture of just being financially smart can get you a pretty, or like it gets you, it allows you to get the prettier home or bigger
Mhm.
home and better area too, because at that price range, right?
Correct.
That's wild. Okay, I know you have another scenario for us.
Yeah, so this one's right here, like when we're looking at when we pull somebody's credit, right? We're looking what monthly payments and installments they have, right? So again, this probably person with a credit score of 755 is managing their credit pretty dead on, right? So they, you're looking at them and their housing expense was $4,691.17, like in the previous slide. And they have a car loan of 350. Now their total expense is $5,041.17. Now the total income now to qualify for this is $10,084.36, right? So now let's go to the right side where the credit score, somebody at 630, their housing payment obviously went up because of their credit score. $5,325.65. They probably have a car, they probably have more debt. This is just a scenario, but $500, $300 in credit cards. Now their total expense is $6,125.65. Now they need income of $12,352.75 to qualify, which is borrower one needs $2,268.39 less income to qualify for this mortgage. So keeping track of your liabilities, managing your credit very well, keeping your expenses low just helps you overall when you're applying for a mortgage.
And guys, we see this, we're in real estate, we do this all the time. So I want to make sure everyone understands, what we're looking at here, because it's super important. He named this slide the impact of liabilities. And you always hear the term, oh, the richer get richer, right? The rich get richer, and the poor get poorer. This is why, because rich people have lower expenses because they have good credit. And poor people with their bad credit have more expenses. So their life costs more. For the same routine, for the same everything, poor people are paying more money than rich people because their credit score. So all that money that they're able to save on a monthly basis because they have good credit, all of a sudden they're able to save that much more money every month and then reinvest that much more money over a month over a month over a 10-year period, 20-year period, 30-year period. And that adds up, and it adds up fast. So in this scenario, this is also showing you guys that the more car loans you have, the higher they are, and the more extra payments like credit card payments you have and student loans you have payments out there, it just shows you that your income would have to be dramatically higher, okay, than if you didn't have any of that to qualify for the same exact house. And this looks like what, 20% higher or something like that, $2,200 more, so 23% more you would have to earn, which is really hard to give yourself a raise, guys. So be very careful of the type of things you buy. And anything you want to add to that, Art?
Yeah, because obviously when you guys are looking into purchasing a home, guys, what we see a lot is when you co-sign, people co-sign for cars and so that's challenging, guys. So when you guys see somebody asking you to co-sign for a vehicle, think about it if you guys are in the process of purchasing a home, because that will affect it. So just be careful, guys, on how you utilize your credit. Instead of having 5 or 6 credit cards, just have it all in one. Don't have so many liabilities. Manage your liabilities, have it under control, guys. But yeah, one thing we see a lot in challenges is that people co-sign for vehicles. So just be careful with those co-signing those vehicles for other people.
Right. So if you're co-signing for your sister, for your mom, for your cousin, for your best friend, that's going to impact you, right? Well, especially if for some reason they're late on a payment or stop paying, then it's really going to impact you. So sometimes sharing isn't caring.
Correct.
All right. All right. So that's the information from the liability standpoint. What questions does anyone have in regards to loans and the credit, how debt and credit work towards loans? That way, Art could answer some of those if you have any. Is there a difference on whether you purchase a home with your business or personal info for loans?
If you purchase it with your business?
Do they coincide? Yeah. So the question is there a difference on whether you purchase a home with your business or personal information for your loans?
Yeah. So if you buy a business loan, there's going to be different requirements like down payment. If you buy it for your personal, obviously, you would be able to have like, the first time home buyers of the 5%, but when you buy for business, yes, there's going to be other down payment requirements.
Right. So if you buy a house, guys, it has to be a primary. You could get like, great interest rates and awesome down payments. But if you buy a commercial property for your business, then it's a higher down payment. Now,
Yeah.
if you own a business, guys, if you're a business owner and you pay yourself every month, then Art is going to get the salary or whatever you pay yourself, and then he's going to run your scenario based on what your business pays you every month after all expenses, right, Art?
Correct.
All right, cool. So you would need both your business information and your personal information to qualify for that loan?
So if you're going to go with your business, you're going to, obviously, it depends on what kind of business you have. If you have a corporation, there's going to be separate tax returns, 1120s. If you're running a sole proprietorship, it's going to be on your personal returns and it's going to be on a Schedule C. So it just kind of depends on how you operate your business.
Cool, thank you. All right, if you have any more questions, feel free to raise your hand or write them in here. We're going to have some more time for questions in a bit. Okay, so now I'm going to share some information here. Yes, question.
One question from Facebook. Do business credit cards have higher rates than personal?
Maybe Mike might know.
What was it? Do business?
If business credit cards have higher rates than personal?
I know for vehicles, like if you're going to go buy a vehicle, not so much the credit cards are the same exact rates, but I know just especially from personal experience, when I've had a vehicle and put it under a business, you get a higher rate than just a standard putting it under your personal account.
Cool. And then somebody asked, what's a good credit card you recommend, if any?
And that's all depending on what your goals are. Basically, if you try to travel, then you can get like an American Express. It just kind of depends. If you're really a travel person, then, there's depending on what airline you use, you want to kind of get that credit card because then you're going to get all the miles associated with that. Like I said, the Gold Amex card is a good card for points. And, but then just a starting out card, your credit One or Capital One cards. Those are good cards, beginner cards, to help you build that credit. They don't really offer the points side of things, but they're good starter cards that they typically have a little bit of a lower expectation to start.
So it sounds like it's just a personal your situation type deal. Okay, cool. All right, so we'll go into this. Look at debt is the #1 wealth killer in America. All right, that's a fact. So right here, we're saying when you pay with cash, it always costs less. And I think everybody knows that, right? You actually save/make money when you pay with cash, or a bigger down payment when you don't borrow as much. Secondly, when you finance something, it always costs more. Whenever somebody offers you to finance anything, guys, it's going to cost you money. So you want to listen for those things. So if you're going to buy, let's say, a mattress and you're going to finance it, they're going to charge you some type of interest rate. It isn't free. Okay, so you want to understand that concept, guys. This is just a concept we got to understand. And then that way you just say, you know what, instead of financing this mattress, whether through the mattress company or through my credit card, I'll just go ahead and buy it cash. And then we're going to go over the concept of cash on hand versus carrying debt. Okay, so we're going to go over some of these concepts just that way we could understand it a little bit better. So I'm not going to go over this. Mike already touched on the car example of how much money you could save over time. The house example, Art covered that perfectly. One thing that we didn't cover, guys, on the what happens with that extra cash that you save. What in this scenario right here, I said you get that extra money and then you go and invest it somewhere, right? Whether it's the S&P 500, whether it's real estate, whether it's something else. But right here, treasury bonds right now, they're, investing in the S&P over 360 months with $804 that you saved on your house payment because you had good credit, over 30 years, 360 months, that's 30 years, you earn $916,000. So you can literally almost make $1 million, or actually make $1 million, because you saved $289,000 on the interest over time. And then with that savings, you invested it into something, and that investment grew. So you made $1.2 million by not financing things, right? So this is just like an example that I put together versus financing a property and buying it cash. Obviously, it's really hard to buy cash, but I wanted to just get the concept for you guys to understand it, okay? And you can take that same concept and apply it to Art's scenario where both of them are financed. Understood? All right, so this is the carrying debt concept that we really need to understand. What you don't do, right? It doesn't make sense to have $10,000 cash in your mattress or in your bank account for an emergency if you have $15,000 in credit card debt. Okay, doesn't make sense. Why? Because with credit card debt, you're paying 20.4%. That's the average annual interest rate. So if you owe $15,000 in credit card debt, you're paying 20% annual interest. That means you're paying $3,060 a year to keep $10,000 cash in your pocket. So if you have $10,000 cash in your pocket, guys, what I would recommend, instead of having $10,000 cash, you just go and pay $10,000 towards that $15,000 debt. So now you only have $5,000 in credit card debt. And then that would save you $3,000 a year in interest, okay? And again, it's a concept that we have to understand. And I see this all the time. And let me stop sharing for a bit, because I see this all the time. People come to our office and they go, we want to buy it. I go, great. I go, how much cash do you have? $20,000. Awesome. And then we ask them, how much debt do you have? Well, I have credit cards, I got these car loans, and how much interest are you paying on them? And then once they start saying, oh, I'm paying 10, 12, 15, 20% interest on $30,000 of debt, and I'm looking at the $20,000 cash that they have, it's like, hey, you can save a lot of money by transferring. All it is transferring a stack of cash to the credit card, wiping that clean, and then all of a sudden you're earning 20% a month or a year instead of paying the credit card company 20% a year on your own cash. So it's a concept, okay, that we just have to understand. All right, let me go back. If you have any questions on this, please ask, because I want everyone to understand this.
There is
Okay.
a question on the chat.
Yeah. Does it correspond to this?
It's if credit card should be consolidated.
Great question. I want to answer that because that's important. That's actually a great question. We're going to answer that towards the end. Okay.
Okay.
All right. Bad debt. Okay. AKA liabilities. These are some bad debts to have: cars, quads, jet skis, credit cards, clothing, like stores, Nordstrom's, Macy's, jewelry. These are all liabilities that we're buying. They're not appreciating. They're not giving us any money every month. So these are liabilities. And if we're financing them, most of the time, it's not a great deal because the interest rate is too much. And then there's not so bad debt, aka assets, and that's owning real estate and owning businesses. And you can finance those. I make so much money by buying real estate and financing it. Okay, make a lot of money that way. The plan to create wealth is to eliminate all debt, starting with the bad debt first. So we want to eliminate all this bad debt. Okay. Ways to eliminate debt. Creative. And by the way, we're not going to go over a family budget today, but we have a class where we go over how to create a family budget. Use cash on hand to pay off all debt. Stop bringing on new debt. Use the envelope system. Again, we're not going to go over that today. That's another class. Pay cash instead of credit. So at the farmers markets, restaurants, if they're charging me a fee, guys, I always ask, I go and pay for my potatoes or bananas or whatever I'm buying. They don't sell bananas at the farmers market, actually, now that I'm thinking about it. They sell apples. So when I go pay for my apples, and I ask them, do you charge a fee if I pay with the card? And if they say yes, whether it's 35 cents, 50 cents, $1, whatever they charge on the card, I just pay cash because I don't want to pay no fees. Okay. Debt snowball. This is what we're going to cover right now. Okay. I'm going to show you how to eliminate debt using debt snowball. The other way to eliminate debt is stop loaning money to people. Teach them how to fish or have a relationship. So when you start loaning money to people, all of a sudden it destroys relationships because it creates a master/servant relationship. Okay. And then do not co-sign for people, just like Art said, do not co-sign. Stop cash advances. You're losing tons of money. So whenever you do a cash advance on your check, the fees are just through the roof. I thought about doing that as a business for myself personally, but I was like, I can't do that to my people, man. Just charge them 20, 30%, man, just to charge your own check. That ain't cool. All right, so I'll get back to this. Let me share the debt snowball. I'm really excited about this because if you guys do this, it's really gonna allow you to make big strides. So this is the debt snowball. Okay. By the way, this guy Dave Ramsey, if you read his book, he teaches you how to do all this. Okay, this is where I learned a lot of this stuff from. So you do step one. You write down all your debts and the total payoff. So for example, if you have a Shell gas card, total, you write it down, and then the total debt, and then you write down the minimum monthly payment. If you have a Nordstrom card, you write that down, total amount that you owe on it, and the minimum monthly payment. Tiffany jeweler, $7,200 ring, $95 minimum payment. Jet ski, $9,150 that you owe, and you make $250 payments, and then your Honda, $31,000 that you owe, and then you make $512 minimum monthly payment. So you write all this down, right? This is the form. And if you want to copy this form, you can put in the chat with Claudia directly, send her your information, or reach out to your favorite Lepe Tendwell real estate agent and say, hey, I want that. And then we'll email it to you. Okay. So reach out to someone because you need this simple form. Now, that's step one. Step two is you're going to do in order from smallest to largest. If you saw this, smallest to largest debt. Okay, so you're going to write this down. And then you start to attack the smallest one first. So the smallest one is a $900 Shell gas card. And you just put whatever you could extra every single month towards this, on top of the minimum payment, towards this $900 until you pay it off. So you attack the smallest ones first, smallest ones first, smallest. Once you eliminate this card, okay, then what you do is you add whatever minimum payment you're paying, $25, then you add it to the next biggest one, the Nordstrom card. So $25 plus the $35 minimum payment for Nordstrom, that equals 60. So now your new payment that you're paying every single month towards Nordstrom is no longer $35, it's now $60. And then you start paying that off. Okay, $60, $60 plus whatever else you can scrape up every month. Now you eliminated the Shell gas card, then the Nordstrom's card. Now you have an extra $60, guys, that in payments that you used to have. Use that $60 and you apply it to the next one, Tiffany Jewelers. So $60 plus $95, that gives you $155. So now you're putting $155 every single month towards this Tiffany jewelry, and you're paying down the principal. You're paying down this amount right here, $7,200, less and less and less with this extra $60 here. And then once you pay that off, now you have $155 that just opened up, and then you add it to the next one, the jet ski. So 155 plus 215 equals 370. And then you start making $370 monthly payments towards this jet ski. And then you pay that off. And once you pay that off, you have an extra 370 to go towards your Honda. So 370 plus 512, now that's $882 a month. You start paying that every single month towards your Honda. And then all of a sudden you pay off your Honda and you're debt free. Okay, that's how the debt snowball works. You list your debts from smallest to largest. Okay, and then you start using the minimum payments from the previous debts as you pay them off and adding them to the next biggest one. Okay, this is very simple. It works like a charm. I've had clients that have done this and are now debt free. The only debt that they have are mortgages. Okay, so it works, but it does take time, commitment, dedication, all that, stuff. All right, let's move on. So this is Dave Ramsey's top 25 on how you can start paying off debt. Start consignment shopping. Go to Goodwill. All these secondhand shops. 2, start couponing. 3, cut the cable, internet, phone. Look at your bills. Right now I'm switching carriers. I'm going to save money every single month just by switching carriers. Great, same service. It's all, everyone's going to drop calls. Stop going out to eat. Take lunch to work every day. Break up with your barista. You've heard this about the coffee thing, just less coffee every day. Plan your grocery trips. Go with a shopping list and just stick to it. Because if you just go with your kids, they're gonna start throwing all kinds of stuff inside the cart, and all of a sudden your grocery bill is expensive. But if you go with a list first, just of the items that you want to buy, then you just buy those items. Avoid expensive habits. Golf, kids, home improvement, and of course we're joking when it comes to the kids. All right. Mike didn't smile. Mike's like, yeah, I agree with that. Find free entertainment. We live in San Diego, right? For years before COVID, I would go to the $5 Tuesday night. So I would go to the movies, $5 every Tuesday. That was my entertainment, and I did that for years. And then next door was $2 tacos. So for like less than $10, I had a great night Tuesday. My girlfriends hated me. All right, get a side hustle, obviously, sell the car, stop investing. So if you guys are in debt and you're investing in, crypto or whatever else, it's like you're borrowing money just to invest. Therefore, you're losing money. Okay, so first pay down all your debt and then start investing. Ignore your broke friends, because your broke friends are just gonna go out and rack up all kinds of expenses. Tell your kids and family that you're on a budget. This is huge, right? And part of our budgeting class, we're gonna show you how to do this, but you have to involve your family. And then sell your needed items. Craigslist, offer up. All right. Car payments. All right, we went over all that stuff. Okay, so that's the information we have for you today. It's 7:30, right on the money. We're going to take a couple of questions. Question for the credit guru, Michael: is the 15-3 rule really effective, or is it heresy? And I have no clue what that means. People are laughing though. Or what does that mean?
Yeah, that's a joke. I mean, it's just basically 15.3 is like that you try to like stump the credit bureaus because you're making an extra payment, and it's like, well, it doesn't matter. Just make do it 15 days and then do it before the statement date so that it's saying, oh, you're making two payments. But essentially, it doesn't matter if you take that same amount that you paid the 15 days early and then paid again, use that same amount 3 days before your statement date, it's going to report the same exact balance. So that's just it's a joke.
Okay. All right. All right, cool. Claudia, you had a question.
Oh, it was in the chat. It's the question, if you have a lot of credit cards, should you consolidate, keep the ones with good history and remove the other ones that don't?
Okay, so I'll take this first part. Michael could take the second part. So if you have a lot of credit cards and you owe a lot of money on them, the only reason why you want to consolidate is because a bank is going to offer you a credit card with zero interest for a certain amount of time, for 12 months or 24 months or whatever. So instead of having, let's say, 5 credit cards, and those 5 credit cards, you owe a total of $20,000 between all of them, and you're paying 20% interest. That's a lot of money. That's like $4,000 a year that you're paying in interest alone. And a bank comes along and says, hey, just consolidate, bring those $20,000 over here to this one credit card, and you're gonna have 12 months of interest-free money. We're gonna let you borrow 20,000 interest-free for a year. Now, the smart thing to do is, yes, you take those 20,000 and consolidate into one. You don't cancel those cards. You still have them, and just like Mike said, buy a piece of gum every month or whatever, just keep them alive. The issue is this: these $20,000 of interest-free money, zero, is they always convert. Okay, no one ever pays these off because you're like, oh, I don't have to, pay any interest. I'm good. I'm not going to pay it off. And what happens is, all of a sudden, when they do convert, like after 12 months, and you still owe a balance, then they're making a lot of money on you. So the smart thing to do is, yes, transfer it over and consolidate. However, make sure that you get on this debt snowball thing that I just showed you guys, and then just start really like paying down the principal as fast as you can. That way, at the end of the 12 months, you owe a lot less than $20,000, right? Mike, do you have anything to add to that?
No, yeah, great. I mean, other than certainly, yeah, like you said, take all the interest that you would be paying across all those cards that you're consolidating and make that payment go toward that. So then you have less debt when it's time's up. And then the only time you would want to remove anything is if you're consolidating those cards, and some of those cards you made late payments throughout the years that card was open, and it's hurting you more than benefiting you of keeping that card on the report.
You're muted.
All right, cool. Thank you. The next question is building credit by buying gas a good way to start off building credit? Mike?
Yeah, I mean, once you have the credit card, it's again just keeping a zero balance and making sure if you're going to carry a balance, making sure you're making the monthly payment. That's building the credit. So it's not about what you purchase, it's that you're going to make that monthly payment so you don't have any negative derogatory marks on that credit trade line. And then just month over month, year over year, nothing but time is going to just increase your credit score, and by having that card open as long as possible.
Okay, perfect. All right, I don't think we have any more questions. If we do, just write them in the chat. Reach out to Mike directly, Art directly, or any of your favorite Lepe Tendwell real estate agents directly. Claudia, any final words, reminders that you want to give us all?
No. Oh, yes. We do have, I'm going to be sending in a link if this was helpful, beneficial, and if you guys can leave us a review on our Google page, Yelp page, and to let the community know that we host great workshops. And I know I learned something today, so hopefully you guys all did too.
Awesome. Yeah. And also, if you want to be invited to future events, you could just follow us on Eventbrite, Clyde will type it in there, and then whenever something gets posted, you'll get a reminder. And again, whoever invited you to this, guys, do them a solid. If you took something great from here, go on there, find them on their Yelp or Google page or Facebook page or wherever, and leave them a 5-star review, because they're inviting you for a reason. They want to help you grow your net worth, because if we all have awesome net worths and we're worth a lot of money, we're able to help other people out. Okay, it just makes it that much easier. So thanks a lot for joining, and we're going to keep this open for a bit. That way you guys could jump in the chat and just take some of these links, and then also Mike and Art, if you want to drop your information in the chat, that'd be awesome. Appreciate
Yeah.
you.
Last but not least, there was a funny question that someone has 4 kids. How can they eliminate that debt? My advice would be just make them independent, send them to work.
Yeah, what's that word? You emancipate them right now. They just become adults at 12 and 11. Yeah. Cool. All right. Well, thanks a lot, guys. Have a good night. We'll see each other later. Thank you, Art. Thank you, Michael. Appreciate you guys.
Thank you.
Thanks for having me.
All right. Our pleasure. Thanks.